Sylvia's Traders Lounge welcomes you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Peter Maich, and our theme is consistency and discipline in trading.
I'm going to read Peter's bio and then we can go right to the interview. Peter Maich is a director at Westport Deep Sea Fishing School with 10 years of trading experience. He has been mentored by Dan Shapiro. He has learned from Dan Shapiro's trading flow. We will be discussing about his consistency in trading and discipline and persevering beyond massive drawdowns. So Peter, maybe you can start by telling our audience about your trading journey briefly and what keeps you going in the turbulent times like now with the coronavirus, as well as which markets you trade.
Okay, trading journey, I suppose I started 10, maybe 15 years ago. I'd always been interested in the markets. I got quite serious on trading, short-term trading. I thought it might be a way to make a bit of money, get engaged with it, try something interesting. Ironically, I started trading about the time of the financial crisis. One of my first trades was almost to the day, and I was trading US stocks. I was informed that they move a lot. I think that day, United States steel went from $125 to $25. And so my first introduction to trading was right in the middle of that crash. I thought, yeah, they do move an awful lot, and I had no idea what I was getting into. So that's a long time back there. It's evolved over that. I had several mentors over that period of time, each with a different personality, a different trading style. And I think you do need to mix it up a lot. If you want to succeed, you've got to find a good fit for yourself. Like any workplace, you need to understand your own personality, get a good fit for you, and let your trading evolve over time.
All right. So what can you tell us about your discipline and your consistency in trading? Because I mean, you've had a series of winning trades and losing trades.
It's the trading. There's always a joke going around that trading is 95% psychological, and the other 5% is in your mind. It's almost end of the day, it's an emotional game and it's a mental game. Consistency is very, very hard. Any business is like that. Maintaining consistency is almost impossible. So not change it, getting a style that works, trying something. If you're trading short-term trading, you stick with it. Longer-term trading, you've got to stick with it. Stocks, I've gone from scanning every day for stocks now for working with about five high beta stocks. So it's the same ones every day. You start to see the order flow on them, get used to the personality of each different equity or different stock. Tesla seems to go contrary to the market. If Tesla's going down, the rest of the market's generally going up. So you've got to survive long enough, I suppose, using your stops. You've got to survive long enough to be able to develop some consistency. It's very, very difficult. Not impossible, but difficult.
Good that you've mentioned stops and the fact that you trade in US stocks and equities, and I think Scope Markets will be launching US equities sometime next week. So that's very timely. Maybe you can tell us, early on in your trading career, you were mentored by one very good man, Dan Shapiro. So what can you tell us about how he helped you navigate your journey into trading to be able to learn and also use his mentorship, basically?
So Dan's interesting. I'm in his trading room now, or when I say now, literally in an hour's time I'll be in there. So he provides an active trading room every day. It's very simple process, and it's with the active trading room, there's full-time online engagement with him. So you're dealing with the person. But let's go back a little bit. The first mentor I had was Alexander Elder through Spike Trade. Alex runs this trading room, very successful, and more of a swing style, so longer term swing trading. And that taught me quite a lot about using stops, the discipline of trading, sitting on your hands, being very, very patient. And one of the gems that I got out of Alex is in using stops. If you keep getting stopped out of your trades, go and put limit orders where your stops were. really simple things like that. You can micromanage your trading and get blinded by what's in front of you and not step back and have the ability to look at yourself. You know, they always say that humans don't make good traders, and trying to remove that human element, that guesswork or guessing yourself is important. So Alex Elder spike trading, that was a good introduction to fundamental trading, risk control, use of stops, and just patiently looking and trying to find good entries. S&B Capital, which was Mike Bellafiore, I was with them for a couple of years. They're a prop trading room in the States, in New York. So all short-term trading, 60 traders on their floor. That introduced me to level 2 screens, order flow, various styles of trading. They've got people that are scalping very, very large share sizes, 50, 60,000 share orders for a few cents, through to people holding stocks for a long time. So that was great. Now Dan's got what he calls his PS60 theory, which is around pivots, 60-minute candles. He'll look at about 6 entries a day. So it slows it down considerably. You're only looking for 6 opportunities a day on the hour. On pivots, generally what you call breakout trades, or you're looking for supplies of supply and demand. It's a simple process. It's taken me probably 3 years to come to terms with it. I had to unlearn an awful lot of stuff. So I come in with a lot of biases, think I knew what I was doing, what I was doing. It's taken about 3 years to break my old habits and start to maintain consistency. So yeah, that was a bit of humour. You think you know what you're doing, you just getting smacked around all the time. But it comes through in the end. So Dan has a few training materials. His videos are very simple, they're easy. He's mainly around consistency, just patiently waiting for the trade. It's either an A trade, which is going through a pivot and you take it at certain levels, or you don't bother with it. Anything less than that, as he says, if you trade like a fool, you're going to lose your money, and you can only blame yourself for that. So it's very, very simple, basic advice, but real-time engagement. He calls all his trades out, and you'll see what's going on and get a good feel for his style.
Right. And Peter, if I could ask you, what lessons did you draw from, the mere fact that you've mentioned that it's taken you a bit of 3 years to break your old habits? So what kind of experience would you say kind of got you at that moment where you realized, I really need to continue this consistency? Because you've elaborated for us very well on how, from Dan's various lessons, there's a lot you've drawn from.
Yeah, I'm just trying to, that trigger point is very difficult. If you say, there's a lot of moving parts to short-term trading. Some of my trades are 60 seconds long. There's 2 from yesterday that I'll show you, and the shortest one was Tesla, and I was in there about 60 seconds. So the moving parts to it, you get something that's consistent, something you think that's going to work. You've got to concentrate on the process. I turned off the P&L on my charts probably 3 years ago. If you're looking at the money and you're driven by the money, you'll most likely fail. I don't mean that in a negative way. It's just that the focus is in the wrong spot. So you concentrate on the process. And I've always maintained that if there's, say, 5 parts to the process, 5 essential parts, you only need to perfect one of those or improve one of those to make an improvement in your trading. So I just slowly work on something so it looks a little bit better. And then I work on another part of the trading, good entries. We're momentum trading. So you don't want to get into the mentality of being gun shy and shooting behind the duck or shooting behind a moving target. So you've got to start to become aggressive in your entries, or assertive is a better word. And then you've got to start taking a part of your position off straight away. You can't guarantee they'll go in the direction that you want. So all the little bits and pieces that make up your trading style, just work on something each day or for a period of time. You see an improvement, leave it. Move on to the next thing. And then at some point it just happens. And I've heard Dan say that a lot. He says, if it gets into his thick skull, he'll say it should get into anybody's. So there's a point in time where it just starts working. It's a bit of magic when that happens. But then retrospectively, you can see all the micro changes that you make along the way and the pathway that you've taken to get there.
Wow, that's pretty amazing. And could you kind of just talk to us a bit more about the difference between soft and hard stops? And in your experience as well, what limit and market orders are, just for those who could be, joining us and they're not too sure what that is. If you could.
Okay. Excuse me. So we'll start with stop. So a hard stop is essentially entering a trade with a predetermined amount of risk. So if you're trading 10 shares, 100 shares, you want to get into a trade and you don't want to lose more than $50 on a trade. Right. You'll get in, say, at $100, 50 shares, and you'll put a fixed hard stop, $1 down at say $49. So if the market goes against you and it triggers a preset stop, you'll automatically be taken out of the trade. So hard stops are great. I say they're great when you're learning trading, when one of the disciplines you don't have is the ability to just hit out of a trade when it goes with you. Soft stops are more of soft stops are just in your own mind. You'll pick a predetermined level and you'll get out. I use both. Personally, I like soft stops. There was a major transition in my trading when I went from hard stops to soft stops. You take more ownership of the trade with soft stops. There's nothing to allow the trades to go against you majorly, so you have to pay a lot more attention. You have to get out of them, and you're not giving away control to a platform. Because of the market hours here, I'm up at 1 a.m., 2 a.m. in the morning. If I get out of a trade and I hold a part position, I'm going back to sleep for a couple of hours, I'll always put a hard stop on. So while I'm not in front of the screens, I can limit my risk. So always use hard stops in that situation. Other than that, soft stops. We scale out of all trades. So if we've got 100 or 200 or a 500 share position, we will get into the trade and we'll start taking some off straight away. Pay yourself immediately. Limit orders, market orders, also stops will keep you in the game. Stops will take away, if you haven't got the ability to control the trade, they'll do that for you. Market orders are simply when you want to buy into a stock, and I'm talking stocks, not Forex, although it's essentially the same. You want to buy in at a certain price, you'll, in whatever way you engage with the trade, you'll hit the enter button and you'll take it at market. They're great if you want to get in fast. They're good for stocks with small spreads. The volatility that we've got at the moment, you can see a stock like Microsoft that will normally have, say, a $3 range on any given day, maybe $12 to $15, Tesla up to $40 a day now. A market order, if you're not careful, you'll pay a $2 to $3 spread. You'll get in with 100 shares, say, and immediately you'll be $300 down. So a limit order will be to get into a stock at a set price, like a stop to get out at a set price to cover risk. A limit order, you'll decide when you want to get in, you'll put an order in at that point, and if you get your fill, that's the exact price you'll get. The risk on that is in a fast market, you won't get a fill, or you'll get a partial fill. So they've all got advantages, disadvantages. Short-term trading, limits are great. You can control the price, you know when you're getting in. But you can miss out on the trades. Essentially, trading becomes a mix of everything. Best tool for the job. Big hammer, small hammer, whatever's appropriate for what's happening at the moment.
All right, thank you, Peter, for that explanation. And I think before we go to you visually showing us how you do that, maybe you can tell us, because you're based from New Zealand, you can tell us something to do with the correlation between the New Zealand dollar, the Kiwi, with other asset instruments that you trade, like U.S. equities, and the significance of Australia's economic proximity to New Zealand in regards to your trading.
Yeah, to be honest, I don't pay a lot of attention to it. I've got friends that trade Forex, I engage with it, and I use the Forex for sim trading just to get used to pivots. But the New Zealand dollar, Australia, the economies are linked, well, they were linked. There's no linking at the moment with coronavirus. We're all pretty much in isolation. But the New Zealand dollar, Australian dollar, there's a parity most of the time. New Zealand dollar seems to be quite a good carryover trade for Forex. Some of the bigger traders will take it because of the interest rates. Our interest rates can be quite high at times. But to be honest, I'm really not an expert on Forex, and I haven't paid much attention to it for quite a long time. It's a little out of my scope.
All right, Peter, maybe you can share your screen and then you can take us through your trading approach and basically what you look for in the markets. Okay,
so this is very, very simple. So what we've got up here, I'll go to 60 minutes. So most of the time we're using a 60-minute screen, and we've got it set on 24-hour. So yeah, I've got to set it 24 hours, so it's showing a 60-minute candle all day. After hours is the yellow, obviously down candles, green candles. Moving averages, we're using moving averages as supply zones. So there's a whole bunch of them that I won't go through each one individually, but we're looking for congestion, we're looking for breakouts. You'll see just a simple candle up here, 60-minute candle. It had moved up, touched into the supply zone and fallen back down again. So in essence, we're looking for breakouts above the supply zones, good clean lines. If we were to take a trade, a pivot that would run up above, this is Amazon 1973, we'd be looking to take the stock if it moved up through this with the potential of moving up to that top Bollinger Band. How this relates to real-time trading, let's just get this on 5-minute screen. So using the 60-minute, we'll quite often flick to a 5-minute screen to see if there's any barriers or any overhead supply that will stop the trade. Yesterday, this is Amazon, so it's not far off the open. We can see the stock opened up here, a few down candles, broke out again above this level here, went up with this 5-minute candle here, stalled a wee bit. So what we were looking at was a break above about 1875. So we're saying if the stock will start to break up against this level here, this 1875, there's a potential for it to move up to this Bollinger Band. It just gives you a clear space and some indication of potential movement. So I took this trade yesterday, market order 1875. So I entered at this point here. Let's just blow this up a wee bit more. So we entered at this point down here with it's only a small position, 10 shares, and it ran up immediately to about 1892. I took off half the position up here on slightly different. This is the end of the 5-minute candle. So I took the position here as it moved through. Took some off here, exited the trade here. There was a little bit of a stall. At this point, it had gone up and the candle started to fall off again. I exited the trade. I don't care about what I missed out on. I'm more concerned about the momentum, taking something off and getting a good trade out of it. So that overall trade was about 50 seconds, and I think it was about $9 a share. So it was a good little, very, very fast trade. Tesla was much the same. This one here I chased, and I shouldn't do that. I'd missed the entry down here. So you can see the pre-market action up here. A little wash out, which is great. It washes down a wee bit. The stock still held above the pre-market lows, which are way down here. So it opened up, chased down a wee bit, stalled, started to move up, and the ideal entry would have been when it broke this 378 level, when it started to push back through the pre-market highs. I left it for a bit. I chased it. To be honest, I was concentrating on another trade. I chased it, and it stalled here a little bit, started to push up again. I took that trade there and exited up here when you can see the candle pulled up to the top, started to come down a wee bit, so I hit out of the trade there. There was another one that was under a minute, and that picked up $8 a share. So the essence of Dan's trading and what I'm doing at the moment is short-term trading through pivots. The pivot is being defined as a supply level, overhead supply, or if it was a short, it would be a support level, and getting in and taking off some of the positions straight away. I hope some of that made sense. How are we doing there?
Yeah, we're on, Peter.
Yeah, okay, now that's all good. So look, that's the short-term trading is momentum trading through pivots, reasonably fast action, and being quite decisive in how you manage the trade.
Right.
Is this so that screen shared successfully?
Yes.
Yeah.
Yes.
Yeah, good. So there's really the moving parts of the trade are the predetermined pivots, which you can pick up reasonably, new highs, new lows. In this current market, we would wait for it to test a high or a low, and we take a second entry into it. There's a lot more security in the second entry because there's a lot more confirmation of the trade. If it doesn't happen, you need to be prepared to miss trades, and I think that's one of the hardest things. Everybody wants to get in, everybody wants to make money. There's an urgency about it. You need to be prepared to miss these trades, not be concerned about it. It only takes one good trade to make the trading day, and just be patient and control your setups. With that, you get your emotions controlled. Your trades will be a lot more manageable, and just slowly progresses.
So Peter, what time frames do you work with? Because I can see a 5 minutes time frame with Tesla. Yeah,
okay, so let's just have a look. So generally dailies. So dailies is going to give us a range. So if we look at this one, you can see all the little trades here. Each of these are just short-term trades. We frame the ranges, so you've got your high, you've got your low. So just daily to get some idea of the overall ranges. 60 minute is our golden go-to trades with a whole bunch of moving averages. You see on the 60 minute here today for Tesla, we'll be looking at any break of 458. So the whole number is great. So a break of 458 at that point and a low of 390. So we wouldn't trade within these ranges. We wouldn't worry about the consolidation noise in the middle. We'd look for a breakout on the 60 minute or a breakout on the 60 minute. Ideally, a stock will come up, push through it, retrace, and the second time it goes through, it will be a good solid entry. The first time, it's quite often stops going off. So there'll be stops up there. The stops will get taken out. It'll go up, look pretty good, and fade. The second time it goes through will be new buyers, fresh buyers coming into the market, people that are scared of missing out the first time, and there's a good chance of the stock, the stock running. We'll be looking at a break of 459 with a possible move up to 505. So you've got quite a big range in that, and they'll quite often retrace midway through a range. So we're looking at nice clean space up to here, and then sometimes on the 5 minute charts, we'll look for a bit of overheads and consolidation. So you've got 448, you've got a moving average, Bollinger Band, a good clean trade, maybe a breakout at 52. If there's too much overhead supply, as determined by moving averages, we'll look for a break higher on the 5 minute. But the 60 minute chart is our golden go-to. That's where we base everything off.
All right, I think the members inside the webinar can actually start preparing the questions, and then Dennis will be able to ask those questions to Peter on their behalf. But you can carry on, Peter.
Yeah, I'm not sure where to go to next. Where do we go to? What else we got? I think one of the just on mentors, you can't do this on your own. I spent in New Zealand. I know one other day trader. So there's one other person I stumbled on at SMB, and we talk and chat every morning. I don't know of anyone else in New Zealand trading these stocks. You can't really do it on your own. You may make it, but it's very, very difficult. So I think you do need to engage in some way. Be wary of chat rooms. Just try and find someone that's got a good track record and someone that's a good fit with you. I've had 3 mentors. I've stayed with 2 of them too long, and that held me up. You get a bit. I tend to get loyal, so I think you've got to change around your mentors. You've got to find something that works for you, and just take a golden nugget out of everything. Alexander Elder was around good fundamental trading and risk control. SMB was an introduction to level 2 screens, different styles. And for me, Dan's gone and tied it all together. I like his personality. I like the way he presents, and I like the engagement. You see him in real time, the good, bad, and the ugly. In real time in his trading room, it's very genuine and honest, and you know what's going on. That makes it very highly probable that for me, that I can respect him, and I can get some good mentoring out of his processes. I think it's crucial. I would not be near impossible to do this on your own without help. And it's supposed to probably been about a 10-year journey now. It's still starting to come together nicely.
All right, Dennis, one of my co-hosts, will start taking the questions from the attendees. So I think Felix has a question. So Dennis, please take it away.
Okay, hi, Peter.
Yeah, hi, Dennis.
Oh, hi, everyone. Okay, so before I ask Felix question, first of all, new traders don't quite understand what being indisciplined in trading entails, because the topic is basically discipline and trading consistency. So can you point out some of the things that one can identify early on as signs of lack of discipline in their trading when they're starting out?
Oh, how do we start there? Doing something very, very silly that you know is silly, like eating too much food at dinner time. You know you shouldn't do it, but you do it anyway. There's normally an emotional content to it. Discipline, I think the first thing is to set up a situation where you don't need discipline. So I've suggested to a friend of mine that's trading that his broker will stop him trading if he loses a certain amount of money for the day. So, yeah, traders will have a good track record. They'll get a day, a week, a month, 20 or 30 days of good trading, and then they'll get angry over something. They'll feel the market's done them an injustice, and they'll turn around and lose all of that profit in one day. So it's recognizing your own triggers, recognizing a build up. You may trade without confidence. You may start to do well. You may end up overconfident, exuberant with the trades, increase position size. So unfortunately, a lot of it just takes time to identify your own patterns and your own triggers, and then they'll turn around and lose a month's worth of profit in one bad day's trading or one trade. So prior to gaining discipline in trading, your broker might set you up so that if you lose $100, $200 a day, whatever your maximum amount of loss is, you can't trade. Secondly is using stops. You have to use stops when you first start. You've got to slow your trading down, take what we call A trades only, and use stops. So the first process is limiting any of the bad habits that you may have. And secondly, it's just working on it. I always say trying to work in the third person, trying to observe yourself trading, get that distance, a whole bunch of habits. But really the trading is like is a big mirror. Anything you do in daily life that's not great is going to come out in your trading and cost you money.
Okay. And then another thing, so part of building that discipline is to have a trading routine. So basically, can you advise us on how you can plan your trades much better so that you can have that routine which will ensure that a trader maintains discipline, especially a new trader?
Yeah, it's simply, I take notes. I'll get my routine in the morning is to get up, get online, have a look at my emails, get on Facebook, get hold of my friend that's trading. And then we have a webinar with Dan, about 30-minute webinar. So I'll go through that webinar and I'll make notes. The stocks I don't like trading, Dan presents a wide range of stocks. I don't trade New York Stock Exchange stocks. I don't change small cap. So I make notes of what I do want to trade. I pull only those screens up. So my process is from the webinar, identify the stocks that I want. Write down key levels on those stocks. Just simply note where I'll get in, get out, put the charts out, put the lines on the charts, the levels, set alerts for the levels, and start to engage with the charts and get myself tuned in for it. So that's the first step. And then I might, in today's market, I might not trade for the first 15 minutes. So I'll make a wee note, and making a note, I'll become responsible to it. So it's anything that you do that you're disciplined in, you need to try and take those habits and create that same situation for trading. Literally, if I have a cup of coffee in the morning with 1 sugar in it, I won't put 2 in it. I won't change anything. I get so ingrained in my process, and that's centering. Some people will do yoga, they'll meditate. Doesn't matter what it is, but it's that grounding process to get focused on the market and make that your whole being for a period of time. Anything less than that, you'll be distracted, and that'll cause issues, and that'll get you an emotional response, which will probably take you out of your trades will cost you money.
Typically, yeah, that's well and good. Typically what the listeners want to hear, basically the traders who are out here is, for instance, when I look at your charts, so how do you set them up? What indicators are you looking at? What are the key signals that you're looking at? You know, that kind of a routine.
Okay, from that point of view, we look at the daily charts just to have a look at where it is. I mean, one of the charts I like using is, this is a very, very simple line chart. So up here we've got Microsoft. I've got this on a 5-minute chart. We'll whack it on 60. I've got buttons on it. I've got a quick buttons for daily charts, 60-minute charts, 5-minute charts. The Microsoft is almost correlated exactly to the Qs. So I'm trading high beta NASDAQ stocks. Here's a 60-minute line chart of Microsoft, and here's a 60-minute line chart of the Qs. Microsoft is about 10% of the Qs. So if Microsoft moves, the Qs move. The Qs move, Microsoft moves. There's a lag between them. So I use these as an indicator for a trade to let me know whether they're in sync or whether there's a little bit of discrepancy between them and a high probability of a trade moving one way or the other. The actual trades themselves, Tesla will do. 60-minute charts set up with after hours being yellow, green for a high close, red for a 60-minute period that closes low. Bollinger Bands we use a lot, so we've got just standard Bollinger Bands. We've got the center line, lower Bollinger, upper Bollinger. Use those for defining ranges. Moving averages 5, 10, 20, 50, 200. Exponential and standard moving averages. Look for the congestion down here. At the moment, the 60-minute chart is above all this congestion. It's beneath the pre-market highs. So I'll be looking at the chart set up with moving averages for ranges and supply zones, Bollinger Bands. It looks quite complex and messy, but at the end of the day, it's actually very, very simple. And you're looking for breaks into clean areas. So go through each chart, put the levels on them. What have we got for Apple? I do use point and figure charts, an old-fashioned style chart. They have no time element to them. So we're looking at, look at Apple here. I'll look at the chart. Let's go into the daily. So come off the highs up here. You can see that it's made a few lows. It's above lows. There's a bit of recovery going on. Yesterday was it closed off the highs. Just get a feel for where it is. It's off its bottom and probably forming a short-term base. 60-minute chart. You can see it's gapped up after hours. Made a high up here, faded a wee bit. So we'd be looking on the open. If it were to push down into this area down here somewhere, I would probably take a risk on buying that for a quick rebound. Later on in the day, it would be a short around here, and we'd be looking for a break of this high. It's pretty much all we're looking for. In between is just noise. Wouldn't bother trading within these open ranges. So I'll go through my 5 or 6 charts like that, frame the ranges, get a feel for the after hours action, and write down a couple of key levels. Potentially put in limit orders if I think there'll be a clean break through that level.
One of the listeners is asking, what is the best strategy you can advise for a beginner to begin to use when beginning forex trading or trading in stocks? You know, that basic strategy that they can be able to apply it without any much difficulty.
Set yourself up to win. Define your risk. And learn to truly accept that risk. So don't look at your P&L, don't look at the profit, don't concentrate on the money. Define your risk in the trade. You need, like, it's a chicken and egg. You need to have a good trading process to be successful in the markets. You need to survive long enough to get that trading process. When I started trading Amazon about 8 months ago, I'd trade 1 share, and I'd trade at such a small level that the losses wouldn't worry me. I'd say if you were to walk down the street on a very, very busy day and some money fell out of your pocket, how much would you not bother picking up? And if that's a $10 note, You want to start your trades off with no more than a $10 risk, an amount of money that absolutely does not matter to you. And you can get into those trades, you can concentrate on the process, knowing that if you're going to lose a very small amount of money, it won't affect you emotionally, and it won't start to build bad negative habits. So understanding your pain threshold, how much you're prepared to lose, and then slowly start working on your method, whether it's self-created or whether it's by some mentor. We've got members in Dan's group that trade many thousands of shares in Tesla, but some days in the last 2 or 3 weeks, they're down to between 10 and 100 shares. They just won't put themselves at risk, absolutely will not do it. So starting out habits is to trade very, very small. The markets will always be there. There's always opportunity. Trade in a way that's not going to cause any emotional harm or financial harm, and then start to build your process from there.
Okay, cool, fantastic. So I have one final question from me. So basically, on a personal note, okay, what are some of the bad habits that you encountered when you are starting out in trading, and which are basically common that you can point out?
Yeah, bad habits. Where do you start with those? There's a bucket full of them, lots of them. Probably getting hung up on the money, getting yourself in a position where you get frustrated, allowing the markets to get to you. Learn to take 5. If you've got children and your children are starting to annoy you, stand up and walk away, take a deep breath, don't engage. So being able to just move away without getting angry or annoyed or revenge trading. Concentrating on the money. I think that the hardest thing for me has been in some of the trading rooms when you're learning and everybody's telling you how well they're doing. I made this much, I made $1,000 on the trade, I made $500 on the trade. Try not to let anything get to you. I just find that so frustrating where I'm struggling to make it work and people are telling me how much money they're making. And then over time, a lot of those people disappear. You don't hear about your bad trades. So a reality check on the markets is trying to stay in your own little world, trying not to let other things influence you, and again, concentrate on that process. It's all process. Concentrating on the money and focusing on the money, I think, is just a very negative approach and just simply doesn't work.
Okay, fantastic. Thank you. Do you consider any fundamental criteria when it comes to selecting the stocks that you want to trade?
Yes, I do. I've gone to one NASDAQ stocks, and that's simply because TradeStation charges too much for the data for New York stocks. So I stick to NASDAQ. I like NASDAQ stocks. I like the high beta stocks. So you can see down here, we've got Apple, Amazon, Microsoft, Netflix, Nevada, Tesla. So all the high beta stocks, there's institutional buying in them. On the level 2 screens, when we're looking at order flow, it's very easy to see when the big buyers are coming in, when the big money's starting to get into the stocks. So those stocks are very liquid. You'll have no problem getting in with any share size, getting out with any share size at the price you want. The spreads are quite reasonable. As I said, they're liquid, high beta players within them, and they're less affected by the algorithmic trading or the black box trading. So the stocks I'm looking for are any of the high beta stocks that the institutional buyers will be engaging with, hedge funds, big players, and the stability that brings. I don't bother with the small caps at all.
Okay, right. So right now, are you actively participating, or you've taken a break? And is it sometimes good for traders to take a long breaks, for example? For instance, if you have been through a consistent down period.
Okay, so I trade 5 days a week. So in New Zealand at the moment, I'm getting up 10 to 1 in the morning for a 1:30 a.m. market start. So I'll trade 5 days a week. I think you need to enforce those breaks. Don't allow yourself, like the hard stocks, don't allow yourself to make that decision. If you trade too much, get fatigued, you won't be able to walk away. So I trade 5 days a week. I'll do Monday, Tuesday, or the US Monday, Tuesday, I'll get up at 1 in the morning. Wednesday, I will get up at 6 or 7 and trade the last 2 hours. The last few months, I've been quite successful in the late morning trading. So 4 days a week, I'll be getting up early. 1 day a week, I will be trading late session. If I'm tired, I don't get up. I don't beat myself up for missing a session. And I'll quite often 2 or 3 times a year, I'll go away on holiday for 3 or 4 weeks at a time. I'm lucky that I can do that and take a total break from trading. I won't bother looking at anything. So you need to set a schedule that's not emotionally draining to you, and in a way that also gives you time, allows you to dedicate to trading. And you can't trade at home with people running around the house. You can't sneak it in between meetings at work.
Okay, fantastic. One last question, and this is going to be a true or a false question. True or false?
Awesome.
It's going to be true or false. So, trading psychology equals risk management. True or false?
True. Probably 2 trues on that one. As true as something can ever be.
Okay, thank you. Thank you very much, Peter. Thank you. So I'm going to hand over to my colleague.
Okay, thank you. Thank you.
Right, Peter, you mentioned something about liquidity and the fact that you prefer NASDAQ technological stocks. Can you just explain to us why liquidity is important, especially when you're trading, in the financial markets?
Yeah, so liquidity is the ability to get your orders filled. It's not so much whether the stock does 1,000 or 10,000 or 1 million shares a day. It's the way those orders come in. So I'm trading small stocks. It's like a game of pool. You're always trying to set up for your next move. If you play for the move in front of you, you've got no strategy. There's no way to to get 3 or 4 balls down in a row. So my trading has gone from 10 shares, 50 shares, 100 shares, up to around about 500 shares in Microsoft. Now, for me to progress past that, for the traders that trade 4,000 or 5,000 shares, there's no point in focusing on stocks where there's 500 shares can get filled, but at 1,000 shares you can't get filled. As the trades get bigger, the risk gets bigger, the ability to get in and out of stocks changes. So the liquidity and the ability to get in and get out of the stocks with orders, getting orders filled is very important. The high beta stocks turning over millions of shares a day, big blocks of buying, there's no problem with that at all. So I know that at some point in the future, if I was trading 2,000 to 4,000 shares at a clip, I'll get my fills where I want them, and I'll be able to scale out of those trades in a very easy way. The last thing you want to do is get caught with a big position and a stock gapping down, going against you, that the spreads open up too much. So those big stocks have high liquidity. They also have fairly stable spreads, and that adds up to the ability to, over time, scale in and out of much bigger trades.
All right, and just out of curiosity, based on the current events that's happening in the financial markets in regards to the coronavirus, and I heard that the New York Stock Exchange would ideally be closed, I think, next week. Will that affect your trading in any way, or has the dollar valuation affected your trading in any way?
Okay, so the exchange rates haven't affected our trading other than the value of the trading, but I'm not drawing out of my account. I'm just letting that build. Look, if it's an odd one, I don't know. At a guess, if the NASDAQ, if New York Stock Exchange were to close down, there'd be an awful lot of money that's not in play. I assume that would flow into the NASDAQ stocks. That would add more liquidity, more buyers going into the NASDAQ stocks. We've seen some really smart moves lately that, the US is pumping. They're talking about $1 trillion rescue package. That stopped the markets from crashing. The NASDAQ twice this week has been on hold for 15-minute periods due to a 7% drop. That they won't open. That stopped the panic buying, algorithmic trading causing a crash. So the ranges are wider at the moment. There's a lot of very fast action. So if it closes, we can't trade. If one closes, like anything, the money flows to another market. It's not going to be a big deal trading. It's very good trading at the moment. It's some of the best trading I've seen in years. So it's not a great situation, for people's health or for the economy, but it is a good trading market, wide ranges and liquidity. That's exactly what you need.
All right, I'm being made aware that the CEO for Scope Markets will actually be launching the U.S. Equities on their trading platform this weekend. So I think the timing for this webinar is very good. So the guys who are listening in, you can actually be able to take lessons from today's webinar and apply that in from next week. And now maybe as we conclude, Peter, you can tell us which, I know you've mentioned Alexander Elder, you can tell us which books you would recommend for novice and also advanced traders when it comes to discipline and consistency in trading, as well as trading U.S. equities.
Douglas. To be honest, I could send these through to you to put up. There's The Disciplined Trader. I think it's gentleman name of Douglas is one of the best books I've seen. It just takes in a very, very simple, logical way. It takes you through risk management and getting you into what I would call a trader's mind. There's a lot of books out there on fundamental trading. There's a lot of books out there on candlesticks. They're all the same. The Douglas's books on disciplined trading psychology are very, very good. They're very simple. They're not from a clinical perspective. They're from a trader's mind, how to get you into the right frame set. It's set up as a set of exercises, very, very good reading. And there's also an audio book version of that. I'll send you through the links to a reading list later on, and you can put that up somewhere if you want. Might be a better way to do it.
All right, maybe your last and final words to us today.
What would you say? Just enjoy the process. You're doing this, do it for the right reasons, do it because you enjoy it. Learn to laugh at yourself and just enjoy the process. And it takes time. I always project into the future. I'm already a very, very successful, highly paid trader. I just need the future to catch up with that vision. So don't forget you're doing it because you want to, and don't get hung up on the small stuff. Learn to laugh at yourself and take a deep breath.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.